6:45 I left. 6:45.
Okay ค่ะสวัสดีค่ะทุกท่านนะคะทั้งที่อยู่ที่นี่แล้วก็ทางเว็บไซต์ก็ตอนนี้ได้เวลาการนำเสนอข้อมูลของบริษัท PSL Shipping จำกัดมหาชนหรือ PSL ก็จะนำเสนอข้อมูลโดยคุณคาริด ฮาชิมจะนำเสนอข้อมูลในอัปเดตในเรื่องของผลภาพรวมของอุตสาหกรรมนะคะที่ผ่านมาแล้วก็จะตามด้วยมิสเตอร์คูชูวาเดียในเรื่องของผลประกอบการไตรมาส 3และในช่วงสุดท้ายเป็นคำถามคำตอบซึ่งก็ยินดีรับทั้งภาษาไทยและภาษาอังกฤษนะคะค่ะเชิญคุณคาริดค่ะ
Good morning, everybody. Before we start, may I suggest that we take a minute of silence to remember His Majesty, the King of Thailand. Thank you. Now, we will do the presentation as usual in two halves. In the first half, we will talk about the industry structure, and in the second half, we will discuss the financials of the company. So if you look at the slide that is up before you, you can see that pressure shipping is now part of the geared sectors in dry bulk shipping, and that we are in the small handies, from the small handy space all the way to the ultramax space. Please keep in mind that we don't carry any containers, nor do we carry any liquid cargoes. All we carry are dry bulk commodities. This is a snapshot view of the Baltic Dry Index beginning in 1985 and coming up all the way to the current position. So you could see that in the most recent position, we have touched an all-time low. If you were to look at the same index on an annualized basis, you would see that the current year and the average for the first 9 months of the BDI makes it the lowest ever in the BDI history. The last time that the index was at an all-time low was in 1986 when it touched an average of 715 points. So we are well below that today. If you look at the averages for each of the 3 quarters, then you can see that in the first quarter the index was at a level which was less than 50% of the last all-time low. Since then the index has come up, but yet we are in a very precarious situation. So looking at the items that could further impact the BDI, if we look at it from the demand side, China has really done very well. Steel exports are up by 2.7%. Iron ore imports are up by 9.1%. Coal imports are up by 15.2%. And the share of Brazilian ore exports into China has gone up. And this is quite important because the ton-mile impact from the Brazilian iron ore is much more serious than, has a much larger impact than from the Australian iron ore. Chinese steel production in the first 9 months of the year has been better than what was there before. In terms of scrapping, this began very well in Q1 with 14 million tons scrapped. But in Q2 it dropped down to 8.65 million tons, which was good, but not as good as the first quarter. And in the third quarter, it was a rather disappointing 3.24 million tons. In terms of crude steel production, China has done very well in the last 7 months. It has been up every single month. If you look at the overall cargo position, and this is from Clarkson's, you would see that we expect a cargo growth of about 1% according to Clarkson's. But if you see the actual facts on the ground, it would suggest that demand has grown in the first 3 quarters at somewhere between 2 and 3%. If you look at the asset values and compare what happened in 1985, 86, 87 with the current position, then you can see that we are still in a downward trend, and that the bottom has been reached, you could say, in 2016 first quarter. If you look at operating expenses, you can see that we are finally reaching a slightly lower number in 2015 as compared to what was prevailing in 2014. So the downward trend in cost is quite apparent now. If you look at the past 1985, 86, 87, you can see clearly that there was a sharp downward movement in terms of cost. But the downward movement in cost which we see currently is very, very marginal. In terms of time charter rates, you can see that in 1987, rates jumped up by more than 50% over what was prevailing in 1986. We don't see that as yet. We still see a falling trend. But we think that the bottom has been reached in terms of the index and the earnings per day per ship during Q1 of this year. In terms of the overall supply side, in the first 9 months of this year, as you can see, the overall world fleet has grown. It is now almost 11,000 ships. The average age has come down to less than 8.5. The total deadweight tons is 785 million tons, and the average size per ship is around 72,000. As you can see in the lower part of the slide, on the extreme right hand column, you can see the actual growth in terms of tonnage in each sector, whether there's a positive growth or a negative growth, and the overall at the bottom row, which shows you that in the first 9 months of this year, roughly 14 million deadweight tons have been added net into the dry bulk fleet. If you look at the balance of orders still to come, you can see that in 2016 there is still another 37 million deadweight tons to be delivered during the fourth quarter, or roughly 4.7% of the existing world fleet as of the 1st of January. If you look at 2017, there's about 38 million tons, or another 4.83% still to come. 2018 starts to slow down at 18.5 million tons, and 2019 has 7 million tons. So we can see that the forward order book is now slowing down quite significantly. If you look at the way the orders have been placed, you can see that the ship owners got really excited with the developments in the freight market during 2007, and they ordered almost 110 million deadweight tons of ships during that year. 2008 was not too far behind at 105 million tons. Similarly, 2010 and 2013 were in excess of 100 tons each. Finally, you see that in 2015 the order book is starting to shrink, that people are stopping to order new ships. If you look at the scrapping activity, if you look at the skyscrapers that are there, you can see that the skyscrapers have been very impressive in 2012 and you can say in 2016. But if you look at 2012 and look at the quality of ships being scrapped in terms of the age profile, you can see that we were scrapping very old ships. So there is still a lot of ships left to be scrapped in the fleet. If you compare that with the 1986 skyscraper, you can see two differences. One is that Younger ships were scrapped during 1986, average age being 15 years, and that the skyscraper, though it is small as compared to what you see in 2012 and 15, it is still 4.8% of the existing world fleet at that time. So it was a significant amount of scrapping. We've not had that type of scrapping in a long while in the recent past. If we compare the projected deliveries per year, expected per year, and compare it with the actual deliveries per year, you can see that slippage has been increasing year over year, and finally in this year we expect that slippage will be around 55%. If you were to apply that slippage of 55% and assume that the scrapping rate that we have reached in the first 9 months is annualized for 16 as well as for 17, then you will see that the net growth during 16 will be about 3%, and in 17 it will be a negative 1%. So we really need this to happen, and unfortunately ship owners have slowed down the scrapping, and we hope that that will pick up during this quarter and the next few quarters. In terms of changes in the macroeconomic indicators, the IMF continuously downgrades all their predictions. They start the predictions at say 3% growth rate, and then by the April revision they brought it down to 2.5%, and then by the July revision they bring it down further. So you can see that every year the expectation is for a higher growth rate, but the reality is that the growth rate disappoints all of us. India is one of the few supporters of the dry bulk market in terms of their imports of coal and their imports and exports of food grain. India will be short of wheat this year, and we expect that India will import about 3 million tons of wheat in this season, for the grain season. There are problems with the energy sector. There are plenty of bankruptcies in the United States. Oil prices being low have led to a lot of stress on the balance sheet of many of the oil companies. So all these factors will come out and stop further capital expansion in these industries. If you look at Europe, Europe is the only place where growth rates have continued to perform despite Brexit. So Europe is, but it's of course at a very, very low level. And Japan is still not yet out of the woods. So Abenomics has not really had great success in Japan. In terms of the dry bulk market, of course, China is the single largest and most important player for us. And so if you were to look at the GDP growth rates of China, you can see that the GDP has been consistently slowing down. However, if you look at the iron ore imports as an example, and we've annualized what we've got in the first 3 quarters for the year, you can see that this year we expect more than 1 billion tons of iron ore to come into China. So there is good growth from China, both in iron ore imports, in coal imports, in steel production, in terms of steel exports. So if you look at it from those points of view, China is really outperforming and supporting the dry bulk market very consistently. Again, just to show you in graphical terms that the Brazilian iron ore imports into China is increasing, and this is really, really important because the Brazilian ton mile impact as compared to the Australian ton mile impact is roughly 3.5 times greater. In terms of railroads, look at the 3 big countries, China, India, and the US. You can see that both China and India really need to expand their rail networks, and China is planning to do that through the One Belt, One Road. So in terms of PSL strategy for 16 and 17, it is to expand our fleet but cautiously, and to sell the older ships, which we have done, And of course, once the market starts to improve, to fix our ships on long-term charters. If you look at the fleet profile, you can see that currently, as of the 8th of October, we've got 37 ships in the water. The average age is now a very sprightly 5 years. The insured value is about $747 million. The book value is about $724 million. The total deadweight is about 1.6 million. And the average size per ship is about 42,000. When the expansion is over, we've got still 2 ships to be sold, to be disposed of, mainly for scrap. And we've got 2 more ships to come. So we end up again with about 36 ships in the fleet, at which time we will have an average age in 2017, early 18, of just 6.5 years and an average size of about 44,000 tons. In terms of the rules and regulations for shipping, the 7 rules are still the same. Do not buy any assets during peak years. We have avoided doing that very consistently. To sell older ships and cash profits, we've done that consistently in the last big cycle. Unfortunately, we did not manage to do that in the current cycle. Do not speculate. That's the 3rd rule. We have no such speculative instruments in our balance sheet. Fix your ships on long-term charters. We've got 7 ships still out of the 37, which are on really long-term contracts. Deleverage your balance sheet. This is something we will do once the income flow starts to get better. And reduce dividends to the minimum when you have a higher leverage in your balance sheet. Obviously, when you're not making profits, you can't pay dividends. And last but not the least, acquire ships during the low point of the cycle. So this is a snapshot view of our assets and our acquisitions, which is the red line, against the BDI, or the Baltic Dry Index, which is the blue line. So you can see more or less that we have been very contra-cyclical. So whenever the cycle is down, we've been expanding. Whenever the cycle has been up, we've been shedding tonnage. If you look at the earnings per day per ship in terms of our fleet, you can see that like when the BDI drops precipitously as it did in 2008-9, our earnings really did not fall as much. In fact, they went up. So this is a result of the longer term contracts that you are able to generate at when the markets are high. This is the current and rolling 4-year forward book. The black line represents the earnings per day per ship of the 7 ships that are out on long-term contract. The red line represents the total number of available days in the fleet. And you can see the percentage line, which is the purple line, and the green bars give you the number of days which have already been pre-booked at the price indicated in the black line. If you look at the market segmentation and look at the Q3 results, you can see in Q3 that the Baltic Handysize Index averaged 399 points, which resulted in a time charter rate of 5,792. Against that, we earned 7,325, or we outperformed the Handysize Index by 27%. If you look at the BSI, or the Baltic Supermax Index, it averaged 676 points and resulted in a time charter rate of $7,064, versus which our returns per day per ship was 6,636. So we underperformed the index by 6%. Our objective, of course, is always to outperform the index. Now, Khushru will take you through the financials.
This slide gives you the status of the new building orders from Sanfu. As you can see, we have 3 outstanding new building orders. One of them will be cancelled, and the rest 2 will be delivered during the course of the next 1.5 years. As far as Sainty is concerned, we had, as you know, we had 14 orders or 14 ships to be delivered from Sainty, out of which we took delivery of 2 ships, and the rest 12 orders have been cancelled. Out of those cancelled orders, we received the refunds of whatever installments we had paid from 3 of the orders, and therefore now 9 out of these 12 remain in arbitration. So arbitration proceedings are ongoing for these 9 contracts or 9 new buildings. Plus, we have also commenced arbitration for warranty claims against 2 of the ships which we took delivery of. So therefore, we have 11 sort of contracts or ships in arbitration with Senti. 3, we have received the refunds, and that is closed. If you look at the financial highlights, Q3 versus Q1 and Q2, Q3 has been reasonably good if you would compare that with Q2, and of course if you would compare with Q1, Q1 itself was of course a very, very weak quarter, as we had reached all-time lows as far as the index was concerned. So therefore everything would reflect the all-time low and the low part which we are going through, because we are still not yet out of the woods, as you can see from the previous slides which we presented, where the BDI average even for the third quarter remains quite low. So, and this quarter we did take further impairments for 2 ships which we will be selling during the course of the next few quarters, and this more or less would close our selling or scrapping program for ships. So beyond the next 2, we do not have any further immediate vessels to be sold, and therefore we do not now expect any impairment of any vessels to be done, for this particular reason that we had to sell them at current low values. If you would consider this loss on impairment and loss on sale of ships as sort of non-cash losses or non-recurring losses, then in that case, without that, we had a loss of about $6 million. And this time again a very positive EBITDA. As you would recall, for the first time in our history, because of the all-time low which the Baltic index had touched, we had a negative EBITDA in the first quarter. This is a first ever in the history of the company. Since then, of course, Q2 has been decent. We had a small EBITDA of about $4 million, and then the third quarter again we had higher EBITDA of almost $7 million. So then that has of course come out of the fact that the time charter earnings or the TC rates have improved substantially from the low point in the Q1. So in this particular quarter, Q3, we had a reasonably decent TC rate of about $7,000. The other bright spot is that our operating expenses continue to go down or remain at low levels, particularly when you compare that with the industry levels. So that is something, that is an advantage which we have held on to ever since the beginning. We had therefore, without taking the recurring losses, we had a loss per share of about 16 satangs per share, which is quite close to what it was in the third quarter of last year, and much better than the first 2 quarters. So in a sense, it perhaps gives an indication that the bottom has passed. If you look at the next slide, that gives you the status of the balance sheet or the assets and liabilities of the company as compared to what they were at the end of last year. The big differences are on account of, as you can see, the number of ships have come down from 45 to 36 as a result of our sale programs where we are selling the older ships. So at the end of the third quarter, we had 36 ships. Excuse me. We have, of course, a higher cash balance as compared to the end of last year on account of the debenture issue which we did in the early part of this year of about $100 million. Most of that debenture proceeds were used to prepay outstanding long-term loans where we had to bring down the secured debt levels to be able to comply with the loan to value covenant which we have in all our secured loans. So typically secured loans have a covenant that the loan should be maximum 80% of the value of the ships. So in case the ships values go down, as they do when the markets are down, the values go down. So in case the values go down and the loan to value covenant or the ratio breaches this 80% and becomes more than that 80%, in that case we have to remedy this breach either by adding value, that is by giving more security, or by reducing loan, that is by prepaying the loan. Considering the fact that we do not have any additional security to give to our secured lenders, we took the opportunity to prepay some of these loans to be able to keep in compliance with our financial covenants on the loan to value side. Other than that, this is the reason why you see that our loan for existing ships, that is the long-term loans, have actually come down quite a bit, almost by over 20%. That has, of course, most of it has come from the proceeds of the debentures. Other than that, of course, you see that their total liabilities because of the debenture issues have indeed gone up by about $50–60 million, and equity is reduced on account of the book loss which we have in the first 9 months. After considering all of that, you can see we have our book value is 25 cents per share or 8.55 baht per share. This slide gives you a breakup of what our operating expenses comprise of. The big part of the operating expenses, as you can see, which is almost 60%, is crew costs. This is the money which you would spend on the crew in terms of their wages and other expenses for managing or for operating ships. Other than that, you have repair and maintenance, dry docking, oils, management charge, etc. as the operating expenses. If you compare the first 9 months of the last 9 months of the last year, our operating expenses have gone down. Quite a bit has gone down on account of lower repair and maintenance and lower dry docking expenses because of the sale of the older ships, whereby the age has gone down, and also the delivery of the newer ships, which require less operating expense to maintain them because they are brand new. This is a comparison of the operating expenses with the industry. This comparison is done on a sort of annual basis based on the Moore Stephens & Co. report, which is received. Moore Stephens & Co. is a accounting firm or an auditing firm based in London who comes out with this operating expenses based on a survey of all the shipping companies in the various sectors of shipping. So if you look at our 2015 operating expenses, excluding dry dock and special survey cost, which of course is not included in the Moore Stephens report, you will see that our operating expenses were in 2015, $4,100 as compared to $5,100 of the industry. So we are approximately $1,000 less. So if you see over the course of the last 6 years, right from 2009, and in fact even before that, the company has always had a lower operating expenses, with the difference ranging from $1,000 per day per ship to even $1,400 or $1,400 per day per ship. The next slide gives you the same picture, but in a picture form or in a chart form, in a graph form. So which indicates, as always, that there is this gap between the operating expenses of the ships which are owned and operated by other players in the industry as compared to what the company operates. This one gives you a historical picture of the two key numbers, the two big key financial numbers, and if you look at them with the other two numbers, that is the blue line and the box, the bars, the box on the top of the slide. If you look at them together, it gives you a picture of how the company has fared and what the company has done right from 1995. So to summarize that, as you can see, operating expenses being the red line has followed a more or less consistent trend from 3,000 to reaching a peak of over $5,000 in one particular year, and that peak was reached when the average age, that is the top box's peak, was reached. So when the average age was at its high of almost 21 years, that point the operating expenses were at their highest. However, in the same year when the operating expenses were at the highest, the earnings were, the time charter earnings were also not at the highest, but at the second highest level ever in this particular period. So therefore, that higher operating expenses of about $500 extra did not really hurt the company because the earnings were much, much higher. So here you see that there are more or less two peaks reached. One peak was in 2005, which was about $14,500 in terms of the earnings, and then you had another peak in 2008, and after that it has been all the way down, and this more or less reflects how it has been in the industry in terms of the overall markets. So the drop from 16,000 to, let's say, around $7,500 in 13, we have reached that point somewhat slower than a lot of other players in the industry. This is on account of the fact that we had during the 5 years following the all-time peak and then the fall, we had the longer term charters which allowed us, or which gave us the opportunity to manage our earnings at reasonably high levels and be better than what it was in the industry. When these longer term earnings started to fall down or started to expire, in that case we are now more or less reflecting how it has been in terms of the market levels. But we continue to outperform or sometimes underperform, as you have seen in the benchmarking section of the earlier presentation. So this is how it has been. Another point to be noted here is the average size of the fleet. When we started off in 1995, our fleet average size, that is one average ship, was about 20,000 tons. We are now at almost about 42,000 tons. So this gives you an indication that we have expanded, not really so much in terms of number of vessels, because at our peak we had even 54 vessels. We have 36 only as at the end of last quarter. So we haven't really expanded in terms of the number of ships, but we have expanded in terms of the size of the ships. So therefore, we now have larger ships than what we had in the past. And the other last point to be noted here is that we now, our average age of the fleet, if you see the top box, is under 6 years. This is the lowest ever. So this is the transformation which has taken place, and which is what our target has been, that is to transform our fleet from old, not obsolete, but let's say with old technology ships, less fuel efficient, to modern, larger and more fuel efficient fleet. So now we have a modern, large, fuel efficient fleet, which when the next upturn comes will allow us to take advantage of that market upturn and earn probably more than what our peers who continue to remain in the sort of older profile of the fleet, we should be able to outperform them. Now, this one of course gives you an indication of what our debt levels are and what our debt to equity ratio looks like. Obviously, considering the losses and the stress which we are seeing in the last few years, and the fact that we are expanding, we have expanded and we have bought new ships, or we have ordered new ships, and these ships, of course, most of it has been financed through debt, which is very, very normal in shipping, that most of your financing of assets is done through debt. So therefore, debt has gone up consistently from 2006, 2007, where we had zero debt, and now we are at a point where we are 1.15 times the equity, which is also not very bad or not very aggressive at all, because our debt equity covenants prescribed by our banks allow us a debt equity ratio of 2 times, and we are at around the 1.15, 1.25 levels, which means that there is room for higher debt which we could raise in order to be able to remain in compliance with all our secured banks, all our financing ratios, and even remain in compliance with our creditors on the operating side. Funded debt to EBITDA, of course, looks sort of unreasonable number, but that is purely because of the fact that EBITDA is at all-time lows. In fact, the fact that we have positive EBITDA itself is an achievement. There are most companies today, I would say more than 95% of companies in the world today in dry bulk shipping do not even have EBITDA. The other slide again reflects the stress that after for the first time once again in history, we are looking at cash operating losses. Even during the previous low points in 98, 99, we did not have cash losses, but in this year, and to a small extent in the previous year, we are now looking at, we have incurred cash losses. This actually gives you an indication of the stress and the lows which the markets have breached. Net profit, cash profit, of course, there is no net profit. There is less of a cash profit, let's say, and therefore, once again, the last 2 years show a sort of a dismal picture. Just wanted to sort of get everybody aware that this is a reflection of what is the rates or what are the rates in the markets. And if you would compare that with other shipping companies in the world in the same sector, on a number of parameters, you would find that the company has and continues to outperform on a number of parameters, whether it is in earnings levels, whether it is in operating expenses levels, whether it is even in terms of debt levels, etc. Next slide, of course, gives you the dividends. We have a policy of paying dividends of 25% minimum of net profit. We haven't had net profit in the last 2 years, so obviously there hasn't been any dividends. We have consistently paid out dividends right from 2003, as you can see. And then we had to stop in 2014. So after 11 years, we had to stop, and last 2 years has been a time when obviously no dividends could have been paid. This slide gives you an indication of the financial profile. Once again, a reflection of the times which we are going through, the stress levels which we are going through. So it looks bad if you would compare it with what it was 4 or 5 years back. However, there are a couple of bright spots. One of the bright spots is that the funded debt to equity ratio still remains comparatively quite low. 1.15 is still a reasonably healthy level, particularly at this point where most companies have very high debt and are looking at restructuring their debt or even entering bankruptcy proceedings. So this is an indication of some sort of a financial strength of the company where it is not heavily over leveraged. Of course, the fact that the market rates are still lower than break even if you consider complete everything, that is debt service and interest also. If you consider all of that, continue to remain under market levels. Therefore, there is a strain on cash on the company. So that is some sort of concern which remains. But other than that, there is also a bright spot that the company has the ability or has the capacity to be able to raise cash through debt also. So this is something which is very, very good. The other thing is that earnings are now up to September at about the $6,000 level. So at least in terms of cash, we are more or less at break even. If you do not consider the capital account, that is, if you do not consider debt service, interest and repayment, we are running at break even in terms of operating expenses, including admin charges and even a large part of the interest expense. 6,000 reflects a reasonably good level if you compare it, if you look at it from the perspective of where we are in the market scenario. The other bright spot, of course, is that operating expenses continues to remain under control around the $4,500 levels, which is, of course, as you have seen, approximately $1,000 or could be even more if you consider the dry docking expenses, more than $1,000 level, $1,000 less than the industry. So this gives us some sort of a competitive advantage whereby the break-even point for us in terms of operating expenses is $1,000 or more less than what others have. So to that extent, we would face lesser stress than what the other shipping companies would be facing. Awards, achievements, we continue to do well. We continue to be conferred awards practically from everywhere, from the regulators, from agencies, from publications. We have the sustainability award. Then in terms of corporate governance, we have been awarded last year for 2014, but which was awarded last year by the Asia Money magazine. We've just received the result of the corporate governance assessment done by the IOD and by the Stock Exchange of Thailand, where we, for the 10th year in a row, we have got a 5-star rating. And we continue to remain in the top quartile of, in terms of corporate governance, of all these 5-star rated companies in our sector. So this is something which we continue to stress on as a management, as a company, and that we do not try, we try and not lose sight of this in spite of the difficulties which we face in terms of the markets today and in terms of where the industry is. So corporate governance continues to remain, investor relations always lauded, always been awarded. Ranking, as you know, Marine Money does a ranking worldwide. Dry bulk continues to fall in this ranking now, given where the dry bulk sector is right now. So as a result of that, pressure shipping, if you look at overall ranking, which includes shipping companies in all sectors, whether they are cruise, LNG, tanks, tankers, container ships, etc. There, of course, we are in the last year and in the last 2-3 years, pressure shipping comes out quite low in the rankings. However, if you look at other companies in this ranking tables in the dry bulk sector, and that were 19 of them, in that case, pressure shipping is in the top half of this particular ranking. That is, among the dry bulk sector, pressure shipping is in the top half and is performing quite well or better than other companies or in the dry bulk sector in the world. And if you look at the parameters, once again, in terms of return to shareholders, pressure shipping would be ranked 3. In terms of price to book value, 5. So which are within this particular subsector of dry bulk sector rankings, pressure shipping ranks reasonably high, quite high in this particular ranking. And this is reflected by the comments which are given by industry peers, by regulators, by other marine agencies, publications, etc. In terms of shareholder returns, if you look at how things are, and if you compare it with what a shareholder who had invested in the IPO of the company a couple of decades back, there the returns or the payback is still very, very healthy in spite of the low point at which we are in terms of our share price. So if a shareholder or if an investor had invested in the IPO about 20 years back, then he or she still would be at a point where his investment would be about 10 times of what the original investment was. And then if you look at, if an investor had entered and made an investment in the company at various times, right from IPO to last year, 2015, in blocks of, we have taken a block of 5 years because one must invest generally in equity with a 5-year horizon, and it shouldn't be for less than that. So if you look at it that way, by and large, barring the last 2010 and 2015, even at this low point today, generally investors would be reasonably well placed notwithstanding at what point they had made the investment. With that, we finish our presentation and throw the floor open for questions.
Whilst we're waiting for questions from the floor, we have one question. We have a few questions from the net. The people who are watching this presentation, which is live webcast by the Stock Exchange of Thailand. So the first question is, will you plan to buy more ships from the second-hand market in the near future? We would love to do that, provided we have the liquidity and cash available with us. Right now, at this moment in time, that is not something that is readily available. If we take the second question, there is another question which is, how likely or in what scenario will the current fleet be impaired in the future? As Khushru has already pointed out, with the sale of the last two ships which have already been impaired and have been taken into in the third quarter, there is no further impairments that we should have on account of sale of ships.
In notes to financial.
Okay, in the notes to the financials, there was details about security shortfall under debt covenant with DNB and ING banks. What are the likelihood of remedies for these problems? Cash prepayment to lower amount of debts. Khushru.
With DNB, we have already remedied this by placing some cash as security, and we expect that when values go up, which they should now, we should be able to get a major part of the cash back. So for this reason, this time we have not done any prepayment. We have actually placed a cash deposit as security, but the moment the values go up, we should be able to get that cash back. With ING, we feel there is some differences in what we think the values are and what ING has got the valuations of the ships. So we are discussing with them in terms of how we can try and match or arrive at values which are acceptable to both of us. So discussions are ongoing. With DNB, it has already been done. If current situation of BDI continues without moving higher, how long can the company sustain before another equity raising? Does the company has internal projection on this scenario? The company is not really looking at any equity raising right now because the company did raise equity last year. So it would not be too fair for the shareholders to be asked to again inject equity. The company would, if the liquidity goes down, particularly because of the loan to value breaches where cash is required for prepayment, and if the BDI continues to remain like this, where it is a cash drain or there is a cash burn of almost $2 million per month is a cash burn, including loan repayments, including the debt service. In such a case, the company may look to tap to other sources to raise cash through debt or maybe even some other form of debt. Could be unsecured debt through debentures, could be other ways in which it could be done. Things like sale and lease back, and there are other ways in which to raise cash, which the company is definitely looking at.
There is a further question from the net asking what is our break-even point in terms of the index. Very difficult to equate exactly with the index, but we can say clearly that for the fleet as a whole, the break-even point on a net profit basis, that is no profit, no loss, would be around $8,500, $8,600 per day per ship. So we think that to get to that type of level, the index should be somewhere between around 1,200 to 1,500 points, the BDI. The next question is that does precious shipping get any benefit from the Chinese government having reduced the number of days that coal mining companies can mine coal in China? Yes, of course, it does make a big difference. As we pointed out in the presentation, coal coming into China this year is going to be about 15-16% above last year. And that is very good for the freight market. We have additional cargoes coming in rather than a negative growth. We have a really strong positive growth of coal going into China, and that is always welcome. There is another question. This is an interesting question. It asks whether the Ballast Water Management Convention would make any significant change in the supply side dry bulk ships. Now, this is something which is really interesting. Currently in the world fleet, there is 16.67% of the dry bulk fleet that is over 15 years of age. Generally speaking, ships which are over 15 years of age under the current index levels are ships that are valued at scrap. So roughly, say for our size of ships would be about $2 million would be the value of the ship. Now, Ballast Water Management Convention comes into legal force on the 8th of September 2017. After that date, any ship that does not have a ballast water management system and which has a special survey or a dry dock coming up due has to install that. Now, the cost of installation is anywhere upward of $500,000 to $1 million, and the cost of a special survey or dry dock for a 15-year-old ship or older ship will be at least $1 million. So if you take the value of the ship being $2 million, then you add to that the ballast water management system, say, of $1 million, and then you add the cost of a special survey or a dry dock of another $1 million. That means that the value of the ship would now become $4 million. But in the market, if the current BDI situation prevails, then in such a case, the market would still value the ship at just $2 million. So it makes very little sense for any ship owner to undergo this exercise of spending almost the same value of the ship and not having any value increase on their books. So we think that the ballast water management system during 2018 will result in a lot of ships in the dry bulk sector being forced to go to scrap. There are no further questions from the internet or from the webcast. So if there are any questions from the floor, we would be happy to answer them. Yes. Excuse me. Excuse 1 second. There's one. In terms of the outlook for next year, we think that 2017 will be very similar to 2016. We don't see it improving too strongly. Our real hope is that the Ballast Water Management Convention will force ship owners to scrap ships in a big way in 2018, at which point in time also, if you remember the supply side tables, there is no new ships really that will come into the picture, and if there's a lot of scrapping, we will have very high negative growth in the world fleet, and that will finally bring balance to the market. So we don't think much will happen in 17, but we think a lot should happen in 18. Yes.
Yeah, I admire your reduction in OPEX expenses due to many reasons which you have explained to the SCT. Would you like to maintain more variable cost than the fixed cost to maintain declining trend in OPEX to sustain business competitive in the region?
The nature of operating expenses is fixed. Nothing can be done. If you have ships, you have to maintain them. You have to maintain them every day, every year, every decade. So you can't do anything about it.
Our question is regarding ROA. You are having 5 stars. I admire from IOD. You are consistently maintaining 5 star of IOD, highly admirable. I would like to know how you can enhance your ROA and ROE in the coming quarter.
In 2018, we hope the markets will go up, where we should be able to outperform and give you the ROAs which you had seen in the past. But more than ROA, I think you should be looking more on ROE, because shipping being capital intensive, ROAs may not, if you compare it with other businesses, ROA may not be a good indicator.
Sustainability Award from Finance Minister. Would you please participate in the coming year to get the similar and consistent sustainability award? That is the biggest asset of your company.
Yes, of course. If there are no further questions, we are also out of time. So I must thank you very much for being such an attentive audience. Thank you very much.